The Sensex and the Nifty had hit fresh record highs. To find out if this momentum will hold in the run-up to the elections and the top stocks and sectors to watch out for, we're now joined by Adrian Movat, the emerging market equity strategist. He joins us on the phone line from Hong Kong. Adrian, good afternoon, and thanks so much for joining in. Is there merit in buying the Indian markets at these levels? Because a lot of the catch-up seems to have already taken place. So the underperformance of the Indian markets vis-a-vis, say, the MSCI emerging market has now narrowed to what, 2 to 3%. So would you recommend buying at these levels?
I think there's a macro global story with equities at this point. If you recall late 2018, there was significant fear around economic growth, much talk about recession in the United States and, concerns about Chinese economic growth. The data out of India wasn't particularly good. Markets start rallying early in 2019, essentially discounting a change in policy. And there has been a profound change in policy by central banks around the world, with obviously the Fed being the most important. But let's not forget that the RBI has moved to a much more dovish tilt than you were seeing even 3 months ago, let alone 6 months ago. Now the markets have rallied, but the economic data is improving. I mean, to some extent, it is still maybe one swallow rather than a trend. But, I would highlight some of the PMI data that's been coming out, whether that's from China. Yesterday, the Nikkei market manufacturing PMI from India was at 52.6, maybe a little bit below the pole, but, still is in expansionary phase. And so I think the story for capital markets is that the weakest point for economic activity is going to prove to be the first quarter. And this rally that so far has been a recovery rally ex-India is now going to move into the next phase, which is a combination of better economic data and very dovish central banks, very low risk-free rates.
Well, Adrian, how do you explain the kind of flows we have seen into our Indian markets? We have not seen it in the last couple of years, but in the last month or so, the flows were very, very strong. So FIs, clearly, they're factoring in a stable government, an NDA government, and also they're expecting earnings to pick up, isn't it, by around 20% odd?
Yes, so if you look at the breakup of flows into open-ended funds, it's been predominantly into general emerging market funds rather than country-specific funds. And India is getting its share of that flows. Earlier this quarter, the specialist EM managers were moving into the year overweight India, underweight China. And at the beginning of the quarter, you were getting a rebalancing effect. I think we've moved through that rebalancing effect. So in the last 30 or so days, there's been less effect from that. And, when you look at the chart of the Indian market, that's certainly coming through in the index performance. And as you highlight, the sort of catch up in terms of the relative underperformance that India had suffered at the beginning of the first quarter of calendar year 2019.
Adrian, I want to pick up on the point where you said that Q1 will be the weakest quarter in terms of economic growth, but thereafter the next phase of the rally will be led by better economic data as well as dovish central banks around the globe. So we're still expecting the rally to continue from here on. How much higher could the Indian markets go, and what is your expectation even for the developed markets and the kind of equity returns they may throw up?
Yes, so I think that there's a couple of points to highlight there. Remember that we're talking about this market reaching a new all-time high. The last time the index was here was August last year. Most markets are yet to hit their all-time high, let alone some of the 2018 highs. Remember, the all-time highs for things like China. You need to go back to either early 2018 or some points in 2017. I think there is further upside in global equities. I see no reason why The S&P can't put on another 10% in terms of performance. This is partly earnings, but partly it's a recovery of the derating that was experienced in 2018. And therefore, I think India will benefit from that. But it is important that, when we have discussions about indices, it hides a lot of color at the market level. If you, admittedly, it was less than 12 months ago that we hit the all-time high in India. But if you look at the one-year performance of the Nifty constituents, you've got stocks like Bajaj Finance, Reliance Industries, Axis, ICICI Bank up more than 50% in the last 1 year. But if you go to the bottom of the table, it's all about sort of domestic India that seems to be underperforming. Big underperformance from Grasim down more than 20%, Maruti, Eicher Motor, Z, Hero Motor, India Bulls, maybe more specific, Vedanta, Tata Motors. And so I think if Indian economic data gradually improves, that you could see some sector rotation towards some of the more domestic consumer discretionary names. And that would be helpful in broadening the extent of this rally, because the rally within the Indian market is notable in that it is narrower than we're seeing in other emerging markets and developed markets.
Well, Adrian, you spoke about a lot of sectors. The last data point that we got in terms of how are things on ground has been the auto sales numbers, and they didn't look very, very good at all. I remember in your past interview, you've said that it may not be the right time to look at Maruti as well as Tata Motors. Does the auto space require relook at these levels after the kind of correction we have seen? Some of these stocks, the Maruti was closer towards 10,000, now it is hovering sub that 7,000 odd mark. Or will you wait for more evidence and only then allocate some money to the auto space?
Yeah, I think the auto space is getting people scratching their heads globally. Germany is effectively in recession because of issues in its auto space. Chinese auto sales are down despite other evidence that the economy is picking up. I think we have a very significant secular technology story going on here. Electric cars are going to be commonplace 5 to 10 years from now. Cars are very reliable, and what we seem to be seeing with the consumer is extending the replacement cycle. They don't want to buy another internal combustion engine car when it may be more appropriate to wait for the electric vehicle to be ready. I mean, if you recall, you used to watch your cricket on a CRT TV. You began to see some flat panel TVs out there, and you basically decided that you'd let your old TV keep running until those flat panel TVs got cheap enough to watch your cricket on. I think the same thing is happening in the auto space. So you've got a secular issue that the industry is having to deal with. It's also having to deal with, let's say, a double capex story where you have to keep your internal combustion engine models fresh while investing in electric vehicles. And I think that's all very challenging. So we might get a slowdown in the deterioration for global autos. But I think for now we've got a secular technology story which is going to keep the space more challenged. Now, it might be the case that in emerging markets such as India, where price points are absolutely critical and the adoption of electric vehicles is going to take longer, and that car penetration is still relatively low, that the numbers are a little bit better. But it feels to me like a sector where you take some short-term trades in because maybe the data doesn't deteriorate as badly as you expect. But it's sort of one that secularly I'm avoiding globally.
Okay. And very quickly, Adrian, we're running out of time. 25 basis points rate cut by the RBI is in the price. How much more would you expect through the course of the year? And anything else by way of commentary that you would watch?
Yeah, look, I think the driver of central banks getting more dovish is probably past us, in that the market is factoring in cuts in India and generally a sort of dovish view of global central banks. That's a very big change from the expectations that people had in September 2018, when, remember, U.S. long rates were 3.25%, and the expectation was the Fed would keep raising and other central banks would follow through. So my view on interest rates is that we've got very attractive risk-free rates. That's good for growth assets like equities. And so the key driver for equities going forward is going to be the macroeconomic and the EPS data. If that is running in line with consensus or beating consensus, then I think equity markets are moving higher.
Adrian, final question in terms of the inverted yield curve. Just a few sessions ago, everyone was talking about it. Are we getting into recession? A few days later, no one's really talking about it. They just brushed it off and equity markets have moved higher. How big a risk is that?
Yeah, look, I think that, as a strategist who's been looking at markets for sort of 3 decades, inverted yield curves were incredibly powerful signals that you responded to very rapidly in the pre-QE world. Since then, the signals from bond markets have not really been all about the market participants' attitude on economic growth. They've had an element to do with central bank activity, to do with QE, and then you get a cross-border influence with that as well. And so I think that we should be cautious in overreacting to the inversion in the yield curve. I'm also a little bit suspicious about the reporting of the inversion in the yield curve because, when you draw the charts, you've got a rather funny shape with relatively low yields around 5 years. Now, in the old days when we were using yield curves for our strategy, it was very much 10 minus 3 years was defined as the yield curve. And when it got inverted, it would often be very inverted, so maybe more than 100 basis points inverted. I think at the moment, with it just being a couple of basis points halfway along the curve, it would be better to consider the economic data rather than to overreact to the bond yield curve.
Adrian, always a pleasure to listen in to your views. So interesting insights coming in, and the global bull market is likely to continue. No reason why the S&P 500 can't rally another 10% from here on.